Now we're going to start looking at chapter 2. And chapter 2 is looking at linking personal accounts and business accounts. And so personal accounting to business accounting. And that's why today I'm in a grocery store today. And before I do this, I want to read to you the Making It Real to you on page 33. So you can use your knowledge of personal accounting to help understand how financial activities are recorded in a business. Think about where you go and how you do business. In other words, start to become aware of your financial transactions. If you were to record all of your transactions for a few months, you would quickly see where your money comes from and where it goes. You would also see the different types of businesses that you buy from. Some are service businesses, like your internet service provider. Some are retail or merchandising businesses, like an office supply store. And others are manufacturing businesses, such as an appliance manufacturer that you might have to order replacement parts for your washing machine. Now consider how you pay for these things. Does the supplier require a deposit or payment in full before it provides the goods or services? Can payment be made after the goods or services are provided? How does the business account for receiving your cash or credit card payment? How does the business handle debt, debit, and credit card transactions? The answers to these questions and many others help guide how such transactions are recorded in a business. Let's take a closer look. We're going to take a look at some of the differences between personal accounts and business accounts. Now, most of what we learned in accounting in a personal context back in chapter 1 is going to be similar for accounting in a business context. However, business accounting is more complex. So differences in terminology between personal and business accounting. So the personal balance sheet and the personal income statement are going to be called the balance sheet and the income statement, respectively. Cash in a business is like cash in personal accounting. However, businesses may have several different bank accounts, and all of those amounts are included in cash. Okay, so a business, it's possible that they might have more than one checking account, but all of those would be listed under cash. Now, accounts receivable we have not talked about yet, but it is a new business asset account. It is the amount that's owed to a business by its customers. This is used when a business sells services or products to a customer and then allows the customer to pay later. And so that we'll talk about. So accounts receivable or AR, that is a type of asset. Now, merchandise inventory is a collection of the physical goods that a company has purchased or manufactured that it sells to customers. It is an asset account that's used when a business sells products to a customer. So anything that is inventory, if it's a business, for example, behind me we see the aisle, the produce aisle of a grocery store. All of that is merchandise. They purchase all of that, and obviously they're hoping that they're going to be able to sell all of that to customers. So that would be considered part of their merchandise inventory. Prepaid expenses are another business asset account. It represents costs that are paid by a business before they're incurred. So it's possible they might maybe prepay for legal services before they're rendered, or they might prepay for maintenance before it's done. So that would be a prepaid expense, and that would be also considered an asset. Insurance is one common that's a prepaid. You might pay for 6 months or a year of coverage up in advance. Equipment, buildings, land, and other similar assets that provide the business with benefits over a long period of time are going to be called plant, property, and equipment, or long-term assets. These assets are not intended to be sold to customers. There's times where we might sell a piece of equipment or a vehicle or something like that, but it's pretty rare that we do that. They're not intended That's not the day-to-day business that we're in. Now, unpaid accounts in a personal context are called accounts payable in a business. Accounts payable are the amounts or debts that a business owes to others. So accounts payable might be, they might have a credit card that they're paying, and so that would be part of accounts payable. They might have a tab that they run with a supplier, so that would be an accounts payable that they would owe the supplier. Or even, well, we'll get there. There's other kinds of payables. Sometimes there's wages payable, which are the wages that are incurred, but they haven't paid yet for their employees. So salary and wages. So we'll talk about that. Now, unearned revenue is an obligation for a business that has provided products or services to a customer. It is used when a customer pays in advance for products or services that are to be used at a later date. And so it's time, again, let's say you're a law firm and somebody's paid you in advance for law service, legal services, or maybe an accounting firm and they've paid you in advance for accounting services. It's unearned revenue until you have actually done the work in order to do that. Or they've put down a deposit. Maybe you're a contractor and they've put down a deposit on a building. Same thing. They haven't earned it until you've actually done it. And this happens, a lot in business. Now, just as a person might have loans and mortgages, a business might also have other long-term debt. Notes payable is a business liability account that's used when a business signs a written document in order to borrow money. So a business might borrow money from a bank in order to build a building, for example, or to do whatever. So that would be a notes payable. Now, when we were speaking in the last chapter about net worth, in a business context, we're speaking of equity. The equity may belong to the business owner, could also belong to the partners or stockholders of the business. It's going to depend upon how that business is organized, the legal structure of the business. Now, revenue is called either service revenue or sales revenue. If a business provides services to a customer, then it's going to be service revenue. If a business sells products to a customer, then it's going to be sales revenue. Some businesses provide both and use both accounts. So some businesses provide both services and products. And we'll see an example when we get to that. We'll talk about that. Now, a business usually has more types of expenses on its balance sheet, and they're going to be broken down into the different types of expenses. A surplus or a deficit on a personal income statement was now called net income or net loss in a business. Net income occurs when revenue exceeds expenses for the period, which causes our equity to increase. A net loss occurs when expenses exceed revenue for the period, which causes equity to decrease. A business pays sales tax on the goods and services that it purchases. It may also have to collect sales tax for the goods or services that it provides. So you have to keep track of that as well. So we see here a chart, and on this slide, on slide 7, we also see that on page 35 of your text. We see the personal balance sheet, the business balance sheet, and a personal income statement and a business income statement. And it's very similar, except for the differences that we discussed. That net worth is now called equity for a business, and a surplus or deficit on a personal income statement is going to be called net income or loss in a business income statement. And we also see, of course, our expenses are going to be very different for a personal income statement than what a business would have. All right, so now a discussion of equity and net worth. Now, equity is the net worth of a business, the leftover value after all of the assets have been sold and all the liabilities have been paid. And for a business that's a sole proprietorship, meaning that one person owns the business, the equity of the business is going to be called the owner's equity. Now, in business accounting, owner's equity gets separated, has a separate section on the balance sheet rather than an account. Because there might be several accounts that are going to make this up, but it's one section of our balance sheet. And so we see then that what comprises the ending owner's capital account balance is going to be our beginning capital plus our additional owner's investment if they invest and add money to the business, plus our net income or minus our net loss, and then also minus owner's withdrawals. And we'll talk about what each one of these pieces is. So the beginning owner's capital is going to equal the ending owner's capital for the previous period, or zero if the company is just starting out. So if a business is just starting out, they're going to have, and this is their first month, their first, income, their first balance sheet, they're going to have zero beginning owner's capital, or it's going to be whatever they start out with from the previous period. Now, the owner's investment or the owner's contribution are the cash, or it could be also other assets that the owner puts into the business. So let's say that the owner has a truck that he is not going to use now personally. He's going to use it now just for the business. That would be an investment because he's now using that, turn that over to the business. If it's only going to be used by the business, or again, obviously money that he's contributing or she's contributing would be the investment or the contribution that they're contributing to the business. That would be part of owner's investment. Now, net income from the income statement gets added to the owner's equity account. So if they have a profit, which would be a net income, it's going to be added to the owner's equity. Now, a net loss is going to be subtracted. And obviously, if a business always is running then a net loss, then it's going to chip away at this amount of equity that the owner has. Now, owner withdrawal are the cash or assets that the owner has removed from the business for their personal use. They are recorded in the owner's withdrawals account. Owner withdrawals are never an expense, so the amount is not included on the income statement, but it would affect the balance sheet. So anytime and oftentimes this is how the owner gets paid, is that they make a withdrawal from the equity, and that's how they get paid, at least in a sole proprietorship. There are situations where an owner might, if the business is set up as a corporation or set up as an LLC, the owner might be an actual employee of the business. And so it depends. And so they would be paid just as any other employee are paid. But this is owner's withdrawal is very typical for us with a sole proprietorship. So we have here on slide 9, and this is also available for you on page 38, we see our business T accounts map. And so in the context of a business, we have separate T accounts that are used for the owner's capital and the owner's withdrawals. And we keep those separate. And then obviously they operate just the opposite of each other. And we see that. And this book is really nice that they do use different colors. And so they use this concept of the accounting map in order to help us to understand, how things fit together. All right. So both revenue and expenses are going to impact our owner's capital. Our revenue is going to increase on the right side of the T account and decrease on the left side. And this is the same as owner's capital. So our right side is the credit side, our left side is the debit side. Now, expenses are going to do just the opposite. They're going to increase on the left side or with a debit, and they're going to decrease with a credit. And this is the opposite of the owner's capital. Now, owner's withdrawals then are going to increase on the left side of the T account and are going to decrease on the right side. Increasing owner's withdrawals decreases owner's equity, and decreasing owner's withdrawals increases owner's equity. Overall, if owner's capital exceeds owner's withdrawal, the impact on owner's capital is an increase. Overall, if owner's withdrawals exceed the owner's capital, then the impact on owner's equity is going to be a decrease. And when you're looking at this and you're reading this and you're hearing this, it would be good to look at page 38 to help you to understand. So you may want to go back on the video and look at it again. So the first question, in business accounting, unpaid accounts are going to be referred to as what? As cash, as a bank loan, as accounts payable, or as a prepaid expense. And they would be part of accounts payable. So an unpaid account is going to be part of accounts payable. In a business context, we said that net worth is referred to as net business worth, as owner's equity, as net equity, or liabilities, and it would be owner's equity. And so remember the accounting equation that our assets equal liabilities plus our owner's equity, and that's how everything has to balance.